How is everybody doing on this Saturday night? Welcome to the Strategy Room. You are with the banker next door, Dr. Joe Berquist, and hope everybody's having an awesome week out there. Hope everybody's having a great day. So we are here on this January 11th, 2024, and we're getting everything rocking and rolling. So a little bit later start than I usually do. Had some things going on this afternoon, but wanted to get in here and get this going with everybody here tonight. So I got a lot of stuff as usual for everybody, a lot of banking news and information from throughout the week. We're going to talk about some of the big stuff that was happening. Obviously, the unemployment report came in. At least once again, headline number was fantastic, really drove the stock market down big time. Market Dow was down 700 points yesterday, all because basically that means Federal Reserve probably not decreasing interest rates anymore. If the labor market is looking really strong, no need for them to decrease the interest rates, at least for a while. And Goldman Sachs at this point has basically priced in a 0% chance of a rate cut, at least until June of this year. But a lot of people are betting that they may not do anything until October. So it could be a long time until we see another interest rate cut. And I'll tell you what, I'll jump into something here. Jump into this real quick here. So I want everybody to take a look at this. I'm going to make this a little bit bigger here. So this is the bonds. This is the bonds here, and I'm hoping everybody can see this okay. So basically, the 10-year bond. Look at what happened here with the 10-year bond. So basically, job report comes in. We immediately jump up to 4.769%. And I've said it a million times that the 10-year treasury, that is what drives everything in your personal life, whether it's credit cards, residential mortgages, student loans, you name it, it all rides off of that 10-year treasury. And I said a couple of weeks ago, for anybody that might have been watching, I said that if the 10-year treasury went over 4.5%, I said, look out, because it's going to make a run up to 5. And what's happened here? We've shot right up to 4.76 here, and it's getting pretty close to 4.8. And I wouldn't be surprised if it gets pretty close to 5, or goes maybe even, it's like what we call in stock trading, you call resistance levels. You get levels of support, you get levels of resistance. So it'll be interesting to see if it gets up to 5% and then kind of hits some levels of resistance there at that 5% rate. Like sometimes it'll go up to 5%. It might test it, might come back down a little bit and then go back at it again, might jump over a little bit, but then might come back down. So we'll have to see what happens there. But, Janet Yellen, once again this week, she did not disappoint. She gave an interview just the other day. And I almost have to laugh because it's almost comical at this point. But she gave an interview the other day, just a couple of days ago, where she basically said that, because she had been saying for years that inflation, wasn't the cause, or the government spending rather wasn't the cause of all the massive inflation. That, it was supply chain, it was other nonsense. And then she finally admitted the other day that, all the money that we spent probably played into all the inflation that we've got in the last couple of years. And that's on top of her comments from about 2 weeks ago, where, she finally acknowledged that, the national debt's a big problem. And, we should really look at that. And I hope the next administration really tries to focus in on that. It's just, you gotta love Janet Yellen. She has left us with a giant pile of on her way out the door. So and like I said, Todd, I think it's Todd Besson, if I'm saying, or Steve Besson. Maybe it's Steve Besson, the new Treasury Secretary who's coming in. I keep saying this, like this man. I don't envy this man because he has got a monumental task. And then it came out that basically he's got $7 trillion of debt that he's going to have to roll over this year, which is just an extraordinary amount of money for any head of the Treasury to roll over in any one given year. I mean, it's astronomical. So we're going to get into all of that stuff. I have a number of different articles that I wanted to run into. A little bit later on in the program, I always like to go through, what are the economic indicators coming up this week. I'll talk a little bit about the 5 episodes that I did, this week, the episodes that came out. Some people really liked a lot of the stuff that came out this week. I thought there were some really good things that came out in there. So we'll talk about those items a little bit, but let's kick off with this for a second here. So this is, I just thought that this was kind of interesting. I wanted to run through this with everybody. So I cover, if anybody watches a lot of the episodes and things that I do during the week, I cover a lot of bank director articles. It's I would say it's probably one of my favorite sources I like to go to. But Bank Director put this out. It was Bank Director's most popular articles of 2024 show concern for risk. Bank Director lists the top 10 articles written by the editorial department, which include a behind-the-scenes boardroom battle, an annual ranking of the nation's top-performing banks, and multiple articles on how directors can manage risk. Some of these I covered throughout the year. The first one was 2024 ranking banking report. I covered that report in an episode last year. Small players dominate the best banking list. Number 2 was where have all the buyers gone? I covered that also. That was a great article, just talking about basically giving everybody like an M&A update on what was happening in the M&A world in banking. Number 3 was boardroom battle. I covered this one also. That was a great example there with Republic First Bank that failed earlier this year, and really became kind of the signature bank failure for this year, or for 2024 rather. I keep thinking, I had that early in the year, first couple of weeks, still getting used to 2025. So this was a great article. Just it talked about all of the problems with Republic First Bank, the battle amongst the board of directors, all the just the disruption, the chaos, the craziness that was going on there. I called Republic First Bank Corp was really it was basically like the days of our lives of the banking business. It was that much of a soap opera, but pretty great story there. Number 4 was the broker deposit rule threatens to upend bank balance sheets. I covered this one just about a couple weeks ago, or it was about a week and a half ago. Covered this one in an episode that was really good for this rule, this new rule on broker deposits, and how that could really, really cause some issues or some consternation, if you will, for a lot of banks out there in terms of just managing their liquidity and not necessarily managing the balance sheet, but definitely managing liquidity, how certain deposits are labeled on the balance sheet and what you have to do to just kind of navigate that. So looked at that. And then number 5 was, more banks are reporting slowing loan growth, raising risk concerns for directors. Loan growth slowed in 2024, either because customer demand was down or banks were becoming more cautious in their lending. Directors, however, need to ask the right questions to manage the risk. I felt like I covered this article, but I'm not not 100% sure I did, but I think I did when I was talking about the slowdown in lending. I think I covered it briefly. I don't think I gave it, a whole lot of air or covered it more in depth like I have some of those other articles on the list. Number 6 was, will community banks know when their credit quality cracks? I definitely covered this article. This was a good one. Just looking at credit trends at certain banks and just knowing what to look for when you start to have problems in your loan portfolio. Like, what are some of the telltale signs? When do you know you have issues? When do you know you have to take action? That kind of thing. Number 7 was cybersecurity, CRE, and regulatory risk. What boards face when reviewing the risk appetite. So overseeing risk is one of the critical functions of bank boards. In this piece, Alex gave a rundown about how to oversee the bank's risk appetite and review the risk scorecard. So yes, again, I think this was another article I covered briefly, basically looking at a number of different aspects there from a risk perspective. So, and again, those are nice topics because they're constantly ongoing topics. I mean, cybersecurity is something we're still going to be talking about, 30 years from now. It's not going away anytime soon. Commercial real estate, commercial real estate is such a broad field, and there's so many different facets to it. You got small properties, big properties, you got industrial, office, multifamily, retail. Then you've got construction projects. There's so many different things. There are mixed use properties, and you have owner occupied, you have investment. So there's a lot of things to consider there in terms of your risk appetite and what the bank wants to and doesn't want to focus on. And then, of course, you got the regulatory risk. You've got a lot of different regulators that you have to appease throughout the year. You got to go through a lot of audits, reviews, and they could be internal audits, external audits. So there's a lot of things to consider there. So number 8 was an article that I did a whole episode on, was banks are struggling to find compliance officers. And I thought, that was an interesting topic. So basically said, as the regulatory environment became more demanding the last few years, banks struggled to fill jobs for compliance officers. It's a challenging position. One compliance officer reportedly left for a job at a funeral home thinking it would be less stressful. It's gotta love that. But no, I mean, finding good compliance officers is tough because it has become, there was a time, like when I started in the business 25 years ago, there was a time where banks would simply just have a couple. I mean, you'd have $1 billion bank and you'd have, 2, maybe 3, maybe, and one of those individuals was probably the bank's, like security officer. And they would do a couple things with compliance or whatever, but it was nothing like what it is today. I mean, now you have to have a whole staff of people. There's a whole assortment of things that they have to do, and they have to be responsible for everything from AML to BSA. They've got the deposit stuff to worry about. They've got lending stuff to worry about. There's a lot of stuff like for HMDA, a lot of things, HMDA reporting requirements, things that go in. And so you have all this reporting that goes on, but then they have a lot of little things that you wouldn't even think of. So say, again, if you are covered by HMDA, you make residential mortgage loans, do residential mortgages for your customers. If you were to put something on, say, LinkedIn, you were to put a post up on LinkedIn, well, you got to be very careful about that post and like what's labeled on there. Like, do you have to put, equal housing opportunity lender? You got to put these trademarks and you got to put these stickers and other things on there. And you got to make sure that you have a lot of stuff covered. So it can get very, it can get difficult. It can get difficult, but it's not the easiest thing in the world right now. I think that's the main point, is that these jobs can be very stressful. It could, just a lot going on there. And then number 9 is, why don't banks hedge more? I covered this article. I did our good friend Jason Lang and Bob Newman, who is happily retired. Good for Bob. But Jason Lang took over his position. I did an interview with Jason not too long ago. They are from Chatham Financial. And they specialize in basically helping banks, hedge their loan portfolios, hedge the deposit side, do a lot of derivatives contracts, that kind of thing. So really, really good stuff right there with that one. And then number 10 was the Compensation and Talent Survey, Developing Leadership Potential. So I don't know that I fully covered that survey. I probably did, or maybe a little bit in an episode. But again, I thought it was great because it just gives some flavor for the things that I like to cover here at the channel. A lot of great topics there, a lot of great articles. If you missed any of these things throughout the year, definitely go check the article. Go to the Bank Director website, which is just bankdirector.com. Go check out these articles. Like I said, I covered most of these articles in episodes. So if you want to go check those out, definitely do that. So like I said, just wanted to share that real quick. So now let's get into some articles here. I want to get into 3 things. These are 3 articles, all from CNBC, all from yesterday, all rated around the employment numbers. So what's going on with the unemployment? So U.S. payrolls grew by 256,000 in December, much more than expected, and the unemployment rate falls to 4.1%. So non-farm payrolls surged by 256,000 for the month, up from 212,000 in November and above the 155,000 forecast. The unemployment rate edged down to 4.1%, 1/10 of a point below expectations. A broader jobless measure moved down to 7.5%, a decrease of 0.2 percentage points, and the lowest since June of 2024. Average hourly earnings increased 0.3% on the month, which was in line with forecast, but the 12-month gain of 3.9% was slightly below the outlook. Stock market futures plunged after the report, while Treasury yields soared as traders price in a lower probability of Fed rate cuts this year. So, but just an interesting thing I want to point out is that the November payroll was actually revised lower. Again, a very typical pattern, something that we have been seeing now for basically the last 18 months is basically you get the great headline number right up front, and then last month's number gets revised lower. I think I want to say of the last 18 months, I think 16 out of the last 18 months have all been revised lower. So, so this is just kind of par for the course, more stuff that we're seeing here. So, job growth was much stronger than expected in December, likely providing the Federal Reserve less incentive to cut interest rates this year. Non-farm payrolls surged, and it was above the 155 forecast that the Dow Jones Consensus Bureau of Labor Statistics reported on Friday. So, and then here you could see here monthly job creation over the last few years. But you could see that things were really, starting in kind of April of last year, you could see things really began to kind of slow down overall, 108,000 jobs, then 216, then 118, 144, 78, 255, and then an abysmal 43 in October, and then 212 in November. But like I said, that was revised lower. And then, obviously this 256 number here in December. But you could see starting in January of 2023, basically for the last 2 years, when we had 482,000 jobs created. And then basically it's been, you could draw an arrow straight down, from that demarcation right there in January of 2023. So, but there's a lot behind these numbers. Like you have to, like I always say, like you have to dig into these numbers because there's a lot more going on behind the numbers here than the simple headline number. But let's just read a little bit here. So, it says, this is a hot report, said Dan North, senior economist for North America at Alliance Trade. You have to think that Fed Chair Jeremy Powell is breathing a sigh of relief in the sense that his job just got a little bit easier. Inflation hasn't been moving anywhere for months, so there's no incentive to cut rates. Now you get this jobs report, so you don't need to cut rates to stimulate the economy. The report brings to a close a year in which employment grew each month, though inconsistently, and at times raised questions over whether a recession loomed. However, the final 2 months showed a labor market still operating at strength as the Fed contemplates its next move on monetary policy. One area the Fed officials have stressed to not be a source of inflation is the labor market. The wages grew slightly less than expected. So average hourly earnings increased 0.3% in the month, which was in line with forecast, but the 12-month gain of 3.9% was slightly below the outlook and indicative that wage inflation at least is becoming less of a factor. The average work week again held steady at 34.3 hours. You're never going to hear me complain that we got 250,000 jobs. Chicago Fed President Austin Goolsbee said on CNBC Squawk on the Street, I think it's a strong jobs report. It makes me further comfortable that the job market is stabilizing at something like the full unemployment rate. And then here we go. And then we go. Okay, so retail also saw a sizable gain. Okay, let's take a step back. Job growth came from the familiar source of healthcare, up 46,000, leisure and hospitality, 43,000, and government at 33,000. We're going to get into more of that in just a second when we look at the next article. Retail also saw a sizable gain, up 43,000 after losing 29,000 in November, heading into the holiday shopping season. The sector saw payroll growth of 2.2 million for the full year, down sharply from the 3 million gain in 2023. Revisions for prior months were less substantial than has been in the recent trend. The October count saw an upward change of 7,000 to 43,000, while the November number was cut by 15,000 from the prior estimate. At their December meeting, Fed officials deemed the labor market mostly healthy, though slowing. The Fed voted at the meeting to lower its key borrowing rate by a quarter percentage point while indicating a slower pace of reductions ahead. And let's see if there's just anything else here. Yeah, so let's go to the next article here. So, 10-year Treasury, we'll get to that in a second. So here's where the jobs are for December 2024 in one chart. So non-farm payroll growth came in much higher than expected. Yep, gains in employment took place in several areas of the economy, with healthcare and social assistance leading for a third straight month. Retail jobs in December rebounded from large declines in November. So let's see here. So here's a great chart here, again, showing where did the jobs come from this last month? So healthcare and social assistance, about 70,000 jobs. Retail trade, about 43,000 jobs. Leisure and hospitality, also about 43,000. Government, 33,000. So I want everybody to so keep this in mind for a second. So what has been driving the job numbers over the last year? It has primarily been government spending, government hiring. Think of the IRS adding, getting the approval to add 85,000 new IRS agents. So it's been government hiring, but then it's been the government spending, which again, a huge chunk of that money has been going into healthcare. And that's what's been driving the healthcare to, basically continue to add more and more people in there. You also have to remember we might have had, some people come into the country in the last couple of years, which has kind of ballooned the number of people here. So, you've had a lot of hospitals across the country that have just, seen a lot, they've had to offer a lot more care to a lot more people, which has been a big issue in the healthcare industry. So you're seeing that's really where the bulk, though, it's been basically government and healthcare has really carried the load and been the bulk of the driving force in the job hiring here for the last year. And the question is, what's going to happen here with the new administration coming in? Or is that job growth and that spending going to slow down? And if it slows down, is it just going to slow down a little bit, or is it going to be something more dramatic? So that is to be determined. We will have to see what that goes on here. But this goes on to read, basically says, recently job growth has been very narrowly concentrated in government and healthcare. It's like I said. Julie Polak, ZipRecruiter's chief economist, told CNBC, now it seems like perhaps it's broadening out. Retail growth, a sharp turnaround from steep losses in November, was bolstered by employment increases across key categories, notably clothing, accessories, shoe, and jewelry retail saw an increase of 23,000 positions, while general merchandise retailers and health and personal care retailers grew by 13,000 and 7,000 jobs, respectively. The rise is not just a blip, adding that it reflects other data that shows an improved backdrop in the sector. For instance, the Federal Reserve Bank of Dallas's December Texas Retail Outlook Survey showed an acceleration in retail sales activity. The sales index, which measures state retail activity, hit its highest level since late of 2021. Retailers are more upbeat on 2025 and on the backs of a stronger consumer, Pollock said. We'll probably see more movement in the housing market coming soon. So I just want to add that, this is a little unusual. And why is it unusual? Well, think about the seasonality of what happens there. Like usually retailers hire a lot of people in October and November, getting ready for the big, basically starting, Black Friday after Thanksgiving and then going all the way through the Christmas holiday. So you tend to see a lot of hiring getting prepped for that kind of 4 or 5 weeks right there through New Year's. And then usually in January is when they start laying a lot of those people back off, because they're like, oh, okay, we did the big buildup for the holidays, got all of our retail sales in the door, and now we don't need these people anymore, so we're gonna lay all the seasonal employees off, so to speak. So it's weird that, you didn't see this retail hiring in October and November, but then boom, you got this, huge amount of retail hiring in December, which seemed a little kind of late in the game, so to speak. If you're looking at the normal seasonality, if you will, I find that a little strange. And and I think you have to wonder here too, what are the effects of the election on this? Like, in other words, did people decide to start hiring again because different administrations coming in, and maybe they're a little bit more upbeat about that administration, and therefore they think the economy or things are going to be a little bit better, so maybe they're a little bit more comfortable with hiring a few more employees now that maybe they weren't going to do before. And again, I don't know that to be totally true. I'm just, trying to speculate here a little bit as to what could potentially be happening and why you kind of saw this bump in, in more hiring, especially, financial activities, professional and business services, information, transportation, and warehousing. Here's a big one at the bottom that we're going to talk about this in a second, because I got another article on this. Manufacturing. Look at this loss of 13,000 jobs in December on manufacturing. That's a big deal. That's not good. That's not a good thing right there. And like I said, we're going to talk about that a little bit more in a minute. But let's jump over to this other article. So the 10-year Treasury yield spikes to the highest level since late of 2023 after hotter than expected jobs reports. So the U.S. Treasury yields jumped to their highest level since November of 2023 after the latest jobs data came in stronger than economists had forecast. The 10-year Treasury yield added nearly 6 basis points to 4.745. The 2-year Treasury surged more than 10 basis points to 4.369%. 1 basis point is equal to 0.01%, and yields and prices move in opposite directions. So, we could see here that basically the yield, like I've said before, the yield curve has re-inverted back to positive territory, and we now have a sloping yield curve again, like a what they call a steepening yield curve, as the longer end of the curve, meaning, the 1, 2, 10, 20, or not 20, 30-year Treasury yields, as they continue to go up, and the shorter term yields, the 1 month, 3 month, 6 month, even they got 9 month in there too, even though it's not listed. But as they begin to go down, you get that steepening of the yield curve, which again, most of the time is a good thing. However, as I've said before, when you come out of we had this yield curve inversion that we just experienced over the last few years was the second longest and deepest on record going back. The only one that was worse was the one leading up to the Great Depression. So that should tell you a little something there. And I don't know. I mean, you've got a lot of people. I will just say there's a lot of chatter. If any of you are on X or on, X, or formerly known as Twitter, there's a bunch of the financial people that I follow on there. There's a lot of chatter about a lot of people that are just watching the markets and just study the markets constantly. They're looking at things and going, we're seeing some really bad indicators here that something here could blow up and blow up very soon, like in the next couple weeks, like not like in like a couple months or later in the year, like in a couple weeks. So we're going to have to keep an eye on that. But the problem here with this is that, rates on everything are getting just, driven up. You're not going to see any relief on, your like a mortgage rate. If somebody's looking to buy a house soon, they're not going to see any mortgage relief on this anytime soon. And I'm starting to get the vibe, unless you start to see the jobs, the unemployment really start to falter, unless you start to see a major weakening in the economy, if the inflation does continue to come down a little bit, and you see some type of, the economy really starts to flutter. I mean, that would really be the only reason for the Fed to basically bring rates down this year. I think the Fed is at this point I think they're going to be very happy to sit there and basically not do anything. I think they're going to be happy to just sit there and stand pat and really do nothing the rest of the year and just see what happens with this. And I think, unfortunately, because of the $7 trillion that now has to be rolled over, that's going to put pressure on higher rates, and we'll see that in just a second. So okay, so we covered that, and I'm just trying to think. There was something else I wanted to jump. Oh yes, I wanted to go to, where is my, okay, unemployment here. So I always like to point out, so this is what's called the U6. The unemployment rate that you always get in the headline main numbers is called the U2. Yeah, U2, not the band. So the U2 is what you get in the headline numbers. It was in the articles that we were just looking at, where they said basically the unemployment rate had dipped down to 4.1%. That's the U2. I don't like the U2. I don't think that's really an accurate reflection of the unemployment here. I prefer the U6. And what is the definition of the U6? It is total unemployment plus all persons marginally attached to the labor force plus total employed part-time for economic reasons as a percent of the civilian labor workforce, plus all persons marginally attached to the labor force. So in other words, what does that mean, marginally attached? It means people that are out there looking for a job, but after 6 months, like with the U2, after 6 months, if you're still looking for a job, it's like you drop off the radar, it's like you don't exist. And so you need to look at the U6, because the U6 is who picks up those people that are maybe, people still out there looking for a job, but haven't been able to find one, or, maybe they've been, like I said, they've been out of the labor force for 6 months, but they haven't given up. They haven't stopped looking for a job. They're just not being counted anymore. So, but the point here is that where are we at with this? November of 2024, we're at 7.7% unemployment. That's where we're at. I think that is the real labor market. That's the real unemployment. It's not 4.1%. It is 7.7%. That is your real unemployment rate. So now think about that juxtaposition there from the Federal Reserve. So if you're looking at the U2 number and you're like, oh, we're at 4.1%, and we just had this great jobs report and we just ratchet down a little bit, so there's no reason for us to cut interest rates. If I look at this, though, and I'm seeing, unemployment's at 7.7%, the number of job openings continues to decline, and every month those job reports keep getting revised down lower. And we've had a number of reports that, the Federal Reserve put out their 6-month report for the first 6 months of 2024, showing that the jobs were overstated by 660 something thousand. Then we also had the Bureau of Labor Statistics. They did a revision back in August, which basically said there were over 800,000 jobs that just didn't exist. They've just overstated. So there's 800,000 jobs that were overstated that just didn't exist. So we have a lot of information now basically telling us that the labor market is nowhere near as strong as what we actually believe it to be. But we keep getting these big headline numbers, and they love to focus on the U2 unemployment report, which again is much lower. And I think that one of these days, we're going to start getting real unemployment reports. We're going to start getting the real numbers. They are going to start coming in. And then we're going to start getting closer to the real unemployment rate, which I said right here. Well, like I said, December, it ticked down a little bit to 7.5. But still, huge difference between 4.1 and 7.5. 4.1, no rate cuts. 7.5, holy crap, we need to really bring the rates down. We need to probably cut 100 to 200 basis points. So again, I just want you guys to see just the massive difference there. So there are, we definitely have it. We definitely have issues here. And the point that I keep beating this drum, because you're just not getting the complete picture. The news, CNBC, Bloomberg, love these guys. A lot of professionals there. They're not giving you the real story. That's why you come here. That's why you hopefully love this podcast, because you come here for the real deal. Hopefully. Okay. Oh, and here's something I wanted to show everybody. So here was a thread that I thought this was great. I thought this gentleman, Gordon Johnson, on here, it didn't really follow Gordon Johnson. I just happened to see this post and I thought it was perfect. So it just explained, okay, well, what's going on here with the yield? So let's just take a look at this thread here for a second. So basically he says on here, so the U.S. Treasury yields are likely headed way, way higher. Why? Well, there are three reasons. Namely, one, the two largest historical buyers of U.S. Treasury debt are net sellers currently. That would be Japan and China. And Europe's holdings are also now falling too. Number two, Trump's Treasury Secretary elect Scott Bessent. I'm sorry, I think I called him Steve. sorry, Mr. Bessent. Mr. Bessent is unlikely to follow Senator Yellen's focus on short-term debt issuance. Correct. Writing for his fund, Key Square Capital Management, in January of this year, where he warned over a medium-term horizon, we believe high bill issuance is a risky strategy, and it comes with significant costs. In addition to a higher interest expense, concentrating issuance in short tenors exposes the Treasury to greater volatility via refinancing risks. In other words, you have to roll those treasuries over. You have to roll that short-term debt over. So in other words, let's go back here for just a second. So so you see down here. So when you put 500 billion, right, into a 6-month bill. Well, what happens after 6 months? After 6 months, you have to roll that money over. It's now matured. So now, if you're going to roll that 6-month bill over into, say, you're going to roll it into now a 2-year note. Well, guess what? You're now that's paying more money, and the more, it's a volume game. The more money you're rolling over into that higher yielding note, you're going to put pressure on prices to go higher, and that's kind of the point I keep trying to beat home. So, but let's see here. I lost my spot here for a second. Volatility risk creates the potential for, so in addition to a higher interest rate expense, concentrating issuance in short tenors exposes the Treasury to greater volatility via refinancing risks and creates the potential for a financial accident. Now, accident's an interesting word there. More, I would call that a market crash. And three, the U.S. Treasury has some $7 trillion of debt to refinance in 2025. Exactly what I was talking about a little while ago. So 2.3 trillion in 2024, which is absolutely massive. In general, more debt issuance equals higher yields. Exactly, like I said, volume game. So this is a perfect storm for way, way higher yields. So again, I thought that was a great, a couple little posts there, but he hit the nail right on the head. And it was, just that. And again, that was the whole point that I keep driving home, is that Janet Yellen has left us a major pile of, on her way out the door. And it's not a pretty thing. So, but let's take a look at something different here for a second. Oh, I got clicked out. Hold on a second here. Let's go back here. So this was an interesting, right here. So this was the average monthly budget in the United States. So based on average household income and expenditures. So average monthly eating out, $328. Healthcare, $513. Entertainment, $303. Pension plus insurance, $796. Transportation, $1,098, and that includes auto insurance. Savings, $871. Taxes, $1,161. Miscellaneous spending, $790. Groceries, $504. Housing includes home insurance, $2,120. So that comes to a total number of $8,484 a month. But that's interesting. But I would tell people, why is that a problem? Why is it a problem that the average budget is $8,484 a month? Well, the problem with that is that I believe the average family makes about $74,000 a year or something like that. And that's probably before taxes. You take taxes and everything out of that, you're probably going home with $60,000. You're not making $8,500 a month to cover all that stuff. That's the problem. And if you're getting started, if you're in your 20s and you're trying to get out there and get rolling, guess what? This is a problem. This is a big problem. We're going to have a whole lot of young people that are not going to be able to afford to get out of their parents' house and get started and get rolling. Because again, some people are fortunate enough to get out there right after college. They get a great job, or maybe they land their dream job and they're making really good money. But that's not the norm for most people. Most people, they're going to get out of college. They're going to maybe get a job making, I would say, probably somewhere in the neighborhood of like 30 to 50,000 a year. And then they got to build up from there. It all depends on kind of like what their career is, where they live. I mean, there's a number of factors that play into that. But again, I saw this from Zero Hedge, and I thought this was really good and really gave a great picture as kind of the average monthly budget. And it was great to be able to point out, like, well, what's the issue with this? Why is this a big deal? And it's a big deal because most people can't afford it. That's why it's an issue. So, okay, let's mosey along to some other things here. So this says, some of the other articles here from Investopedia that I had. So what surging treasury yields mean for your finances. So the takeaway, the yield on the 10-year treasury, which affects consumer interest rates and global financial markets, has risen a full percentage point since September, even as the Federal Reserve has cut interest rates by the same amount. So in other words, it's nullified. The last time yields were this high, home sales slumped as mortgage rates soared and stocks wavered. Stocks unlikely to suffer a major drawdown in the near term without an unexpected economic slowdown or a pivot back to rate hikes by the Federal Reserve, according to a recent Deutsche Bank analysis. Treasury yields have surged this week, extending a steady and surprising increase that has raised concerns for investors and consumers alike. We talked about the 10-year treasury going up to 4.73%. In the last 4 months, the yield has increased a full percentage point, even as the Federal Reserve cut its benchmark interest by the same amount. And then you could just kind of see this chart here. You can see here, September, we were way down here, 3.6% here in September, and boom, and now we're up to 4. So basically up a full 100 basis points here in just the last 4 months. What could higher yields mean for mortgages? Well, the last time Treasury yields climbed to the current level in April of 2024, consumer interest rates followed suit. The average 30-year mortgage rate rose from 6.8% to 7.2% between early April and early May, amid a surge in October 2023 when the 10-year yield briefly topped 5%. The average mortgage rate hit a 23-year high of more than 7.6%. So, like I said, why is that? Because the 10-year treasury is tied directly to your mortgages, your 30-year mortgage rate. That's why it goes up together. Surging mortgage rates in those instances reduced housing affordability and weighed on the market. Home sales declined nearly 2% in April as both rates and housing prices increased. That same month, contract signings fell to their lowest level since April of 2020. But what happened to stocks last time? Yields rose. When treasury yields reached their current levels, they also hit stock portfolios. The S&P 500 pulled back more than 5% in the first 3 weeks of April 2024, when the 10-year yield advanced more than 40 basis points. In October 2023, the benchmark index fell in a technical correction as treasury yields peaked after a months-long ascent. So, yes, and what happened to, let's see if we can find it up here. Let's go back here. Yeah, see, look at this. Top left-hand corner of the screen here. I know this might be a little hard to see. Maybe I can blow this up a little bit here. Make it a little easier for everybody to see. So here, so right here, 700 points yesterday. And we've come down off the high, quite a bit. I mean, I think the high was over, 44,000, I think was the high. So, I mean, we're down 2,000 points, a little over 2,000 points here in just the last couple weeks. So, you could see what's, you could see the logic there and what's happening with that. Could rising rates trigger another correction? Yeah, absolutely they could. And then let's see here. So going on here. So hiring surprisingly surges in December. And I think I wanted to, there was something in here. Healthy job market. That's not what I was looking for here. I thought that this talked about, I thought that this talked about job openings, but I'm not really seeing that in here. So we'll skip through that here. All right, well, we'll jump into some other news for a minute. Then I want to get into a few other things before we go on here. So, Biden signs Social Security law that boosts benefits for public sector retirees. So, do you know? I hope everybody understands what that means. Public sector retirees. That means government employees, for the most part. For not totally, but for the most part. President Joe Biden signed the Social Security Fairness Act, which wasn't very fair, into law on Sunday after the Senate passed the bill with bipartisan support in December. The new law eliminates two provisions, the windfall elimination provision and the government pension offset that reduce Social Security benefits for public sector workers who receive pensions. The law will increase the deficit by more than $190 billion over the next 10 years and expedite the depletion of the Social Security Trust Fund by 6 months. Oh, isn't that lovely? Isn't it so nice that Joe gave us that on his way out the door? I mean, that's great for government employees. They're going to get more money out of this, but it's they're shafting everybody else, and they basically just threw threw more gasoline on the fire as it was, So yeah, all I could do is just shake my head. I think that might be all anybody can do at this point. So, just trying to think here. What do I want to? Do I want to finish out these articles, or do I want to go? Let's tell you what. Let's pull back from that for a second. Let's go into because I got a bunch of other news here and other stuff that I want to give to you guys. So, but let's for just a second, let's talk about economic indicators coming up this week. So, what's coming out this week? So, on Monday, January 13th, we have consumer inflation expectations. Also, we get the federal budget balance for December of 2024. On Tuesday, January 14th, we get the PPI. We get FOMC member John Williams is going to speak. We get the API weekly crude oil stock. On Wednesday, we get the core CPI numbers, CPI year over year, month over month. We get the New York Empire State Manufacturing Index. We get the Beige Book at 2 o'clock. Thursday, I got a number of things here. We got continuous jobless claims, core retail sales, initial jobless claims, Philadelphia Fed Manufacturing Index, retail sales, and then business and retail inventories. And then we round out the week on Friday, January 17th by getting building permits, housing starts, and U.S. Baker Hughes oil rig count. So a lot of economic data coming out this week. We got employment numbers. We've got inflation with the PPI and the CPI numbers. We got a lot of manufacturing numbers with the New York and the Philly Fed manufacturing indexes. Consumer inflation expectations. So we got a lot. Yeah, we got retail numbers. So housing starts. We got a lot of stuff coming out this week. So we'll have a lot of information to go into there. Okay. And so now that we got that, I want to talk for a minute, and then I want to go back over because I want to talk about some of the episodes that I had that came out this week. And then I want to go back over, let's see here. Covered this. We covered all this stuff. I'll get that out of here for a second. Okay. So let me just talk for just a couple minutes here. Let me just talk about the episodes that I had this week that came out. So on basically I did on January 6th, I had episode 293, which came out, which was basically an update on credit unions. So I just tried to talk a lot about, well, what's going on with credit unions right now? What's happening with their merger and acquisition activity? I talked a lot about how credit unions set an all-time high last year. They purchased 21 banks. So you have this pattern of credit unions buying banks out there. So that's become a big thing. Also, a lot of pressure starting to build around, credit unions have tax exemption They have a lot less regulation they have to comply with compared to banks. Like they don't have to follow CRA, which is Community Reinvestment Act. So credit unions have a lot of benefits out there, which has really enabled the credit union industry, if you will, to really grow and expand over, the last, 10, 15, 20 years. And so due to the size of a lot of credit, you got a lot of credit unions out there right now that are 2, 3, 4, 5, 6, 7, $8 billion credit unions. I mean, these are not small financial institutions anymore. These are rather large financial institutions at this point. And so that becomes the question. Like, in other words, if you want to act and operate like a bank, then you should be paying taxes and getting regulated like a bank, right? So again, a lot of good conversation there. I think there will be a lot of things that we'll continue to see as the year goes on. On January 7th, I did episode 294, which was the labor market going into 2025. I just tried to give people a flavor again for like what's happening in the labor market. What do we see out there? Like, what are some of the trends? And at the end, I concluded with, what were the top 10 hot jobs going into 2025? And I gave a hint that it wasn't AI related, no AI issues in there. It was just all like a lot of different jobs, a lot of good jobs, a lot of good different industries. So if you're interested in, check that out. On Wednesday the 8th, I did episode 295, which was a recap of the top 6 bank compliance issues of 2024. So what were the big 6, compliance issues? We talked about BOI. The only one that I didn't think was on the list that should have been on the list was open banking. But, we talked about check fraud. We talked about, cybersecurity issues. We talked about a number of different things in there that I have covered in a lot of different episodes on the podcast. But that was a really good episode, just as like a quick recap. Then on Thursday, I did episode 296, effective use of enterprise risk management. And I basically covered a short 2-article series from Bank Director on enterprise risk management. And basically, I thought that was really good. I think enterprise risk management is a great topic. How do you manage risk? How do you embed the management of that risk into the culture of your bank? How do you go about making sure, because it's not like enterprise risk management is not it's not like a hard system, so to speak. It's more like it kind of like an overlay, if you will. Like, in other words, how do you create the risk appetite for the bank and then drive that home through every employee of the bank? How do you drive that through every department, every employee? And that's where having a risk management, system strategy, if you will, that's how you kind of set it up to drive that through the culture of the bank. So again, I thought that was a great topic. Definitely look forward to talking more on that topic in the months and hopefully years ahead. And then on Friday, I did episode 297, which was lessons from Warren Buffett. I want to grab you guys something here for a second. So here is the book. I'm reading this book right now, but this is called Buffett's Early Investments by Brett Gardner. And so far, really good book. It's only 150 pages, so not very long, but he focuses on Warren Buffett's early investing career in the 1950s and 1960s, basically when Warren was just getting out of college and just getting started. And he looks at, what were 10 of the bigger investments that Warren made and how did they work out and what were his strategies? How did he look at them? And it was really fascinating because this guy spent 3 years because again, the information that he was looking for, that stuff is not readily available. You can't Google that stuff anymore from the 50s and 60s. He had to do it the old fashioned way. He had to go to the library. He had to look at the microfilm, microphasia, all that stuff. He had to go through, old newspapers, old Moody's, a lot of different stuff. But it took him 3 years to collect all the research on this. It only took him like a year to write the book, but it took him 3 years to research it and get everything together. But I thought it was interesting because this was not an aspect of Warren's career that has really been focused on up to this point. I mean, everybody, and again, in the early point here, was he basically wanted to focus on some of Warren's like wins and losses, like some of the things that he lost on and some of the things that he won on, because he wanted to show that, hey, Warren was not perfect. He's not a robot. Everything that he touched did not turn to gold. Like he was like any other human being. When they get out there and they get started, they kind of stumble. You're trying to find their way, and they make some mishaps and they mess up. But Warren did have some great strategies, and he did a lot of things that really laid the groundwork for what a lot of professionals in hedge funds and private equity and people in industry or people on Wall Street, like he set the groundwork for the way that they would do things. When you talk about activist investors, buying large positions in companies and then coming in and trying to change that, trying to change the board, try to change the way they do things like that. That was basically stuff that Warren was doing. He set up his partnership, and then he rolled his partnership and then created Berkshire Hathaway. A lot of stuff that a lot of people would emulate in a certain respect by the way that they created hedge funds and created private equity and did, again, started to mirror a lot of the things that he was doing. So again, I find it very interesting. I will, once I'm done the book, I will do a book review on this, but again, the episode that I did was based on a Wall Street Journal article about the book and just talked about that. So I covered kind of the Wall Street Journal article and like I said, so I'll go back. So again, I found that really interesting. I hope some people out there also find it very interesting. So, okay. So I wanted to talk a little bit about this week. I've got some episodes that I've got in, working on for this week coming up. I wanted to talk about ICBA. They just put out a new website or a new page on their website, rather, just looking at like what's their new plan with the new Congress. What are they going to try to focus on? What are the key issues regulatory wise? What are they hoping to achieve here with the new Congress? So I'm going to do an episode kind of covering all of that. But the big thing of the week, though, is open banking. So ICBA, they just put out basically a guide this last week. They put out a guide to open banking. So I'm going to do kind of a special episode, if you will, just on that. I really want to cover a lot of this stuff going on because it's super important. I am not a fan of open banking. I let that be known. I make no bones about it, but I want to try to give everybody as much information I can. It's just like the beneficial ownership deal. I want to get the information out there. I want people to try to understand what these things are, how they work, but more importantly, why don't you want these things? I want to give you the why. Why do you either want or not want this stuff? And then, hey, I give the information, and it's up to you guys out there to kind of make that decision and figure out, like, what do you want to, what do you like, what you don't like, what do you want to press for, what do you not want to press for? So, okay, so there's that. And then I'm probably going to do an update, another crypto series update. I've got an update on, what's going on internationally, like what's happening with a lot of international banks and things going on out there. And then I want to take a little look into cybersecurity, some different things with cybersecurity, and how do you make cybersecurity basically part of your bank's culture? So like last week I did enterprise risk management and working that into a bank's culture. This week I want to do a little bit about cybersecurity. How do you work cybersecurity into your bank's culture? So those will be, the episodes that'll be coming out this week. So I hope everybody will give that a chance and kind of check that stuff out. I'm also a couple weeks. We got Martin Luther King Day coming up. There also might be a big inauguration that day. But I am also looking to hopefully bring you guys the first episode in the financial history series. We're going to be covering the Panic of 1907. So, and I do plan on potentially probably doing that as a live stream. So like I said, I'll let everybody know. I'll try to confirm that this week coming up and let everybody know if I am going to absolutely do that. So, okay. Let's cover, let's cover this news for a second here. So, What do we got here? Housing panel names vice chair. Subcommittee chairs. House Financial Services Committee Chairman French Hill, Republican from Arkansas, announced the panel's vice chair. Subcommittee chairs, vice chair for communications, and committee whip for the 119th Congress. So they have a bunch of people in there. Independent banker, top CEO challenge is growing deposits. So more than half of community bank executives say their biggest challenge in 2025 is growing deposits, according to the latest Independent Banker magazine. According to Independent Banker's latest community bank CEO survey, 54% of community bank executives cited growing deposits as their biggest challenge this year, while 17% said making more loans is their top priority. The shift reflects the temporary impact of pandemic-era assistance, higher interest rates, and more competition for deposits. The January edition of Independent Banker also includes articles on lending outlook for 2025, upcoming regulatory shifts, digital wallet success, organizational charts, and more. Fed's Waller supports further rate cuts. So saying he believes inflation will continue to move toward the Federal Reserve's 2% target. Fed Governor Christopher Waller said he will support continuing to cut the policy rate in 2025. Speaking in Paris, Waller said he believes that the U.S. economy is on a solid foot, noting that real gross domestic product growth has been above 2% for 8 of the last 9 quarters. And he added, I have seen nothing in the data or forecasts that suggests the labor market will dramatically weaken over coming months. So it's kind of interesting. So we'll see, based on everything we talked about a little while ago, see what happens with there. FOMC minutes show rate cuts may slow in 2025. So several participants of the recent FOMC, Federal Open Markets Committee meeting, noted that the disinflationary process may have stalled, and several indicated they were near the point where it would be appropriate to slow the pace of policy easing, according to the meeting minutes. The minutes of December 17th and 18th meeting also showed that officials agreed that inflation is likely to continue to slow this year, though a couple of participants said positive financial market sentiment and economic momentum could continue to put upward pressure on inflation. And most participants said the committee should take a careful approach in considering further cuts. Now, I will tell everybody this: inflation has settled in at well above 2%. It's settled in at basically that 2.5% to 3% range, and I don't honestly see it coming down any more than that. I'd be really surprised if it did. So, wholesale inventories decreased in November. So wholesale inventories, a component of gross domestic product, decreased 0.2% in November, but were up 0.8% from a year ago, according to the Commerce Department. Consumer credit was down in November. So consumer credit decreased 1.8% in November after rising 4.5% in October. The Federal Reserve reported revolving credit, which includes credit card spending, decreased at an annual rate of 12%. Non-revolving credit, such as auto and student loans, increased 2%. Job openings changed little in November. The number of job openings was little changed at 8.1 million on the last day of November, but was still down by 833,000 over the year, according to the Labor Department. Now, I will tell you, it is down a lot because just a few short years ago, that number was over. There was over 12 million available jobs, and now that's dipped back down to 8 million. Service sector index increased in December. Economic activity in the service sector increased for the 6th straight month in December, according to the Institute for Supply Management. Community banker optimism surges at the end of 2024. So community bankers are feeling upbeat about the economic future, according to the Conference of State Bank Supervisors' 4th quarter Community Bank Sentiment Index, which surged 17 points and reached its highest mark since it began in 2019. So that's good. So here's an interesting thing. So the CFPB this week basically finalized a rule to remove medical bills from credit reports. So the CFPB finalized a rule that will remove medical bills from credit reports. The CFPB's actions will ban the inclusion of medical bills on credit reports used by lenders and prohibit lenders from using medical information in their lending decisions. The CFPB said medical debts provide little predictive value to lenders about borrowers' ability to repay other debts. The CFPB's new rule amends Regulation V, which implements the Fair Credit Reporting Act. The rule will be effective 60 days after publication in the Federal Register. And then the CFPB went on to sue Experian for investigations of credit report errors. So the CFPB sued consumer reporting agency Experian for allegedly failing to properly investigate consumer disputes. So the CFPB said Experian does not take sufficient steps to intake, process, investigate, and notify consumers about consumer disputes, resulting in the inclusion of incorrect information on credit reports. So that's some really interesting stuff. And why is that a big deal? Well, here for bankers. Well, okay, I'll put it to you this way. So when banks underwrite, one of the things, like they've already taken a number of things off of credit reports. They've already taken collections, taxes, like delinquent taxes. They've all been taken off of credit reports. So now they want to take medical bills off of credit reports, which is that good or bad? I don't know. I think the problem lies in the fact that, if you're a bank and you're trying to underwrite a loan and you're using a credit report to try to give you an accurate depiction of an individual's credit profile, what are all the debts they have? What are different things they've got going on there? It can give you you start taking all these things off of the credit bureau. What it does is first of all, it artificially begins to inflate credit scores, making people's credit scores seem like they're a lot better than they actually are. That's a little bit of an issue in and of itself. But it could take some very important things away. And in other words, you might make, like, in other words, if I knew that somebody is got a medical dispute and they owe, I don't know, they owe a hospital $100,000 and it's delinquent and there's lawsuits flying all over about it, whatever. Not that I'm going to turn somebody down because of that, but you want to try to understand what's going on in somebody's life, what's going on. Like, do they have big problems? Like in other words, if that's something that could bankrupt them, don't you want to know that? Don't you want to understand that? Don't you want to understand like the risk factor there? Somebody might look like that they've got, great stuff, but then they're going through a divorce and they haven't paid their property tax bill for 3 years. And, and I've seen it. I've seen some crazy stuff. These are things that's like, well, it'd be good to know that, because again, you may not necessarily ask the right questions if you don't know that there are issues out. Like, in other words, like, I may not ask somebody like about their personal life. Like, I'm not going to say you can't sit there. There's certain things you can and you cannot ask people. Like, you can't just walk up in there. Hey, are you in the middle of a divorce right now? Because if you are, like, we don't want to make this loan to you. Like, you can't do that. Like, it's like, so unless somebody offers that information to you freely, if somebody comes in and says, oh, hey, by the way, just want you to know, I'm getting divorced, having some problems, whatever, blah, blah, blah. Like, okay. But these are all, again, I'm just trying to say that, like, again, these could be things that cause issues along the way. We will have to see. Couple more things here. So, panel to take over ISO 20022 harmonization efforts. So the BIS, the Bank of International Senate's Committee on Payments and Market Infrastructures, announced that it will form a panel of global market practice groups to take over the governance and maintenance of ISO. I don't know how you say it's 20. It's not like a number like 20,000. Just 20022 harmonization efforts. Basically, that's fancy talk for payments and market infrastructures, cross-border payments, all that kind of stuff. So they're going to continue to keep an eye on that and continue to work on that. I'm sure I'll have some more information on that as the year goes along here. ICBA says the CFPB's overdraft rule must be enjoined and overturned. So the ICBA said the Consumer Financial Protection Bureau's overdraft rule is likely to negatively affect consumers and their access to banking services and should be legally stopped. And they filed an amicus brief on this. And, we shall see if anything comes of it. Senator Tim Scott has announced that he will chair the Senate Banking Committee during the 119th Congress. Elizabeth Warren will be ranking member. GOP members, Scott also announced the Republican members of the panel will be Mike Crabo, I don't want to say Crapo, Mike Rounds, Tom Tillis, John Kennedy, Bill Hagerty, Cynthia Loomis, Kate Britt, Pete Ricketts, Jim Banks, Kevin Kramer, Bernie Moreno, and Dave McCormick. So the Fed's Barr is stepping down as vice chairman for supervision. The Federal Reserve announced that Michael Barr will step down from his position as vice chairman for supervision on February 28th. Barr's term as a vice chair for supervision was slated to run until 2026. Barr will continue to serve as a Fed governor, with that term scheduled to run into 2032. The Fed said its board does not intend to take up any major rulemaking until a vice chair for supervision's successor is confirmed. And then finally, a call for fairness in credit union policies. Following a record number of credit union acquisitions of community banks last year, ICBA renewed its push for leveling the tax and regulatory playing field, according to a new ICBA blog post. So like I had mentioned a little bit earlier, we've got that credit union stuff going on right now, and we will have to see how that plays out. And like I said, if you want to look at my episode on that I just did last Monday, basically looking at update on credit unions, go and check that out. Okay. All right. I want to get back to a few articles and stuff here before we get out of here, but I wanted to cover this. So I did, what was that episode that I did? Okay. On January 3rd, Friday, I did episode 292, which was ending the conservatorship for Fannie and Freddie. And I just wanted to give an update. So the same day I had that episode come out, this got released. So the U.S. Treasury Department and the Federal Housing Finance Agency added requirements before government-sponsored enterprises Fannie Mae and Freddie Mac can leave their conservatorships that they have been under since 2008. The requirements are part of amended preferred stock purchase agreements. That was one of the three things that was basically preventing this, between the Treasury Department and the Federal National Mortgage Association, or Fannie Mae, and the Federal Home Loan Mortgage Corp, or Freddie Mac. The changes restore Treasury's right to consent to a release and call for the Federal Housing Finance Agency to assess the impact that a release would have on the housing market, along with the government-sponsored enterprises, before ending the conservatorship. The FHFA will also have to brief the Financial Stability Oversight Council about public input and give Treasury a recommended approach for ending the conservatorship. In a January 3rd report, Compass Point Research and Trading LLC analyst Ed Groshans said he believes the changes are an attempt by President Joe Biden's administration to prevent the release of the government-sponsored enterprises from their conservatorship when President-elect Donald Trump's administration takes over. Yes, absolutely, 110%. They want to try to gum this up. The Trump transition team is working with each federal agency to prepare to implement Trump's agenda once it is inaugurated. Groshans said in the report, it appears that the preparations at Treasury and or FHFA have raised concerns for the Biden administration, which resulted in the publication of the letter agreement and side letter agreement. So, in a December 30th post on X, Pershing Square Capital Management CEO Bill Ackman, who said his firm has owned common stock in Fannie and Freddie for more than a decade, predicted the second Trump administration would release Fannie and Freddie from their conservatorships. Ackman also noted that during Trump's first term, then Treasury Secretary Steve Mnuchin made strides toward this effort, but ran out of time. There is some debate about who has the authority to release the GSEs from conservatorship. Isaac Boltansky, managing director and director of policy research at BTIG LLC, said in the December 27th report. Boltansky said administrative action is the most likely path for exiting the conservatorships because Congress has made little, if any, progress toward that end. Still, Boltansky said some strong voices in Washington think that ending the conservatorships should be an act of Congress. But if that's the case, the analyst is skeptical that the GSEs would be released anytime soon. Lawmakers have repeatedly proven either unwilling or unable to legislate on this issue, Boltansky said. After 16 years arguing that only Congress should act on the GSEs is effectively an argument that the status quo should persist in perpetuity. Yes, absolutely, 110%. Um, what is the big thing here? When in the episode that I did, I'll save you a little of the suspense. The big argument here is that these Fannie and Freddie are tremendously profitable. When all things are relative, when all things are normal, and the mortgage market is functioning as it should, these things are cash cows. They are like money printers. They just print churning that money out. And right now, because they're in this conservatorship, who has control of all the profits? Oh, Congress does. And Congress just gets to use that as like their private little slush fund. They don't have to go and raise taxes. They don't have to go and ask anybody for that money. They just take it and they, roll it around in all their little pet projects and all the little things that they want to do. And that is what I have always said is the biggest obstacle. Now you understand why it's been 16 years and Congress has not done anything on this, because they want to, and this is both sides of the aisle now. This is both sides of the aisle. They don't want to lose control over that money because you're going to take their private little slush fund away from them, and they don't like that. And I, guarantee you there was a lot of that, swampy swamp in DC. People going back, basically telling the Biden administration, hey, we need you to do everything you can to gum up the works here to make it very hard for the new Trump administration to get this thing out of conservatorship. And again, where I'm at on this issue is I don't care Republican or Democrat. What I care about is that it's been 16 years and this conservatorship is ridiculous and it should have ended a long time ago. But like I said, they have control. Congress has control over the purse strings, and as long as they continue to have that, they are not going to want to give up the golden goose, so to speak. So, so that's a big thing. But despite, like I said, despite some of these actions, despite some of the stuff that's happening here, I don't think this will prolong it. Will it take the rest of the year to maybe end this conservatorship? Yeah, I think it might. I think it might take the rest of the year to get this thing worked out. But but like I said, I believe it will get worked out. I believe they will get sent back. They'll get turned over. They'll become quasi-private organizations again, and that will be a good thing. That will be a good thing for the mortgage market. It'll be a good thing for the country. It'll be a good thing for everybody involved. So, all right, let's roll down here. Let's just look at some other articles here real quick. I got a few minutes left here. Price sensitive shoppers drove online sales growth this holiday season. So that's interesting. So Americans searching for savings online this holiday season, according to Adobe, which said demand generally rose more significantly when price cuts were bigger. Discounts were relatively generous on electronics and apparel, two categories that help drive online sales. Adobe said overall spending online hit a record of $241 billion in November and December, according to Adobe's estimates. Consumers are more frequently shopping on phones and finding products through influencers and generative AI chatbots. So just some interesting stuff there. Job openings. Okay, this was the article I was looking. I knew it was in here somewhere. This was what I was looking for earlier. So job openings in November. Yes, U.S. unemployment had 8.1 million job openings in November, up from the 7.8 million in October. Bureau of Labor Statistics said Tuesday that was the highest since May and beat the expectations of forecasters who had called for the number of openings to stay flat, according to a survey of economists by Dow Jones Newswires. So again, so this is the number of job openings. So like I said a little earlier, this is March. Okay, this is March of 2022. We had at our peak of 12.2 million job openings, and you can see here it's come down 4 million jobs, and it hit a low in September. It got down as low as 7.4 million, but now it's bumped back up to 8.1 million. So I think one of the questions we have to ask there is is that like a Trump bump in a way? I don't know. We need more trend. We need another, you got to, what is helpful sometimes when you're looking at economic indicators, you can't get an indication off of, 1 month or even 2 or 3 months. Sometimes even a quarter is not enough. Sometimes you really need to look back over 6 months, 12 months, 18 months, 24 months. You need to look back to really be able to take a step back and see the trend, see the trend of what's going on and how it is, playing out in the overall context of things. So we'll have to see. We'll have to see if this trend continues or whether we, fall back off a cliff here again. So, and then what does it say here? However, the uptick did little to change the overall picture of the job market, which is one where hiring and layoffs are both relatively slow compared to the post-pandemic era. There were 1.1 million jobs for every unemployed worker in November, down from the record 2-to-1 ratio in mid-2022, and slightly below the pre-pandemic ratio of 1.2 to 1. Layoffs remain rare, with the layoff rate staying at 1.1%, near the historically low levels where it's been hovering since 2021. Workers were little more inclined to quit than employers were to let them go. The quit rate dropped from 1.9% from 2.1% in October. The lower the quit rate, the less confident workers are that they'll find a higher paid position elsewhere. On the other hand, hiring rates slowed for the second week in a row to 3.3% from 3.4% in October. The report shows an entrenched labor market. So we will keep an eye on more of this. And then as I stated earlier, when we looked at the earlier chart, what was the chart? When we looked at this chart earlier, so this was the chart of where in other words, where was the job creation coming from? And we saw at the top here, healthcare and government, but at the bottom, we had a loss, 13,000 jobs in manufacturing. Not good, not good. So, so this article here, could manufacturing and construction jobs be the economy's Achilles heel? So the job market has been pretty decent lately until you're in the business, unless you're in the business of making things. And that could be a bad sign for the trajectory of the economy. Manufacturing jobs in the U.S. have started to dry up over the past year, even as the overall labor market has expanded. But remember what I said earlier about the government, it's government hiring and healthcare. Those have been our two big main horses for the last year. In November, 12.9 million people worked in the manufacturing sector, down from 13 million in January of 2024. Other measures of how well the nation's factories, such as the Institute of Supply Management's survey for purchasing managers, have been stuck in negative territory for months. Manufacturing jobs, canary in the coal mine, question. And so we could see here, basically starting in May of 2024, we have seen manufacturing jobs almost look like they're falling off a cliff here. Now, it's not that dramatic. It's down to 12.9 million. It had a little bit of it looks like a little bit of a bounce up here from October to November. But it's still a problem. I mean, we've lost 100,000 plus manufacturing jobs, so not great. Although the job decline is just 0.5 percentage point, the trend is prominent enough that at least one economist sees it as a warning sign for the economy's overall health. Combined with struggles in the housing market, the decline suggests construction employment could be headed for a rough patch as well. The broader job market has continued to add jobs over the past year, but economists at Pantheon Macroeconomics pointed out in a commentary that declines in manufacturing and construction jobs have often preceded economic downturns. Yes, we think the economy is in a more fragile position than markets and the commentarian appreciate. Samuel Toombs, chief U.S. economist at Pantheon, wrote in commentary along with Oliver Allen, senior U.S. economist at the firm. Why are manufacturing and home building struggling? The economists point the finger at the Federal Reserve policy of keeping the Fed funds rate at a 2-decade high for more than a year leading up to September. While the central bank has eased interest rates since then, it may not be enough to get manufacturing jobs back on track, another economist said. Here's another angle to this that I just want to point out. So over the last year, you have had a lot of programs. Like you've had like the Inflation Reduction Act, and you've had the CHIPS Act, and you've had a number of other acts that have been out there. Now, those were seemingly great programs on the surface with a lot of money for manufacturers, especially if you were in the semiconductor industry, if you were in some of the other like specialty manufacturing industries out there, segments of the industry out there, if you will. But there were a lot of government strings that came attached with that. Some people would say woke strings. And so there was a lot of companies that didn't partake or didn't take it. that could have really used that money to create some stuff. And that was like, like we saw like with the CHIPS money. So with the CHIPS Act, we went from they couldn't get the money out the door because nobody wanted to take it with all the strings that were attached to it, to basically the money getting shoved out the door here because they wanted to get the money spent. They wanted to, the government, Biden administration wanted to get that money out the door. So that has also played a factor into this. Just added kind of another wrinkle to this. So okay. This was just interesting. I saw this stock of Vistra. This was the top 2025's. This was their best performing S&P 500 company that topped expectations. Now, Vistra shares are higher after its third quarter results, comfortably topped expectations. The electricity provider has been the best performing stock in the S&P 500 this year. Vistra has seen enthusiasm about using nuclear capacity to power energy-intensive AI processes. So VistaCorp, which trades under the symbol VST, shares climbed after the company posted third quarter earnings that smashed expectations after the market closed on Wednesday. The Texas-based electricity provider reported revenues of $6.29 billion, up 54% year over year, and compared to the analyst consensus of $4.53 billion. Net income was $1.84 billion, blowing past expectations of $504 million. Vista also raised its full-year adjustment earnings before interest, taxes, depreciation, and amortization, otherwise known as EBITDA, forecast to between $5 billion and $5.2 billion. So just interesting. Not the stock that I would have picked as the best performing stock on the S&P 500, right? So just something to note. Okay, what else do we have here? I have a couple other articles here. I will probably save some of this for next week, just because we're kind of running short on time here. Was there anything else I wanted to touch? Yeah, Chase is basically bringing employees back to the office 5 days a week. JP Morgan Chase will require nearly all employees to return to the office 5 days a week after starting in March. So Chase has over 11,000 employees in Delaware, which is home to its credit card operations. Additionally, JP Morgan Private Bank has a Philadelphia office at One Liberty Place. More than half of the financial giant's workforce already has returned to offices full-time, according to the memo, a copy of which Chase shared with Columbus Business First, a sister publication. Chase was early to join a growing number of office-based employers scaling back or ending remote work policies adopted in the coronavirus pandemic. Bank branch employees already were in person. So, but I think this was just good because it just shows the trend of companies going back to, in-person work 5 days a week, a lot less remote working. It's just kind of, and I'll save these last couple articles for, I just think it's kind of interesting. I've always felt with the remote work, even during the pandemic, when that whole thing was kind of blowing up and becoming a big thing, I always thought it was kind of crazy because I had a lot of friends, a lot of people that I worked with in the industry that were basically like, oh, I'm, getting a house out here in the booties and I'm going to move an hour and a half away because we're just doing remote work now. And that's how it's going to be and this and everything. And I remember, saying to people at the time, like, are you sure you really want to do that? Because, I don't think that this is going to be this permanent thing that you think it's going to be. And sure enough, like, what happens? We're basically back in an environment of, hey man, we want you back in the office. We want you here 5 days a week. We want you working. And again, I'm not necessarily knocking remote work. I think that there are some jobs out there that you absolutely can and should be done remotely. But I also think that there's a lot of problems with it too. Like, how do you, in other words, if you're going to onboard a new employee, how do you do that remotely? How do you onboard the employee remotely? I mean, really, I don't see how that works. The other thing is just maintaining your company culture. How do you maintain if 80% of your employees work remotely, how do you maintain the company culture? I mean, I guess anything is possible, but I just think that is a very difficult thing to do. And then the other thing is, especially when you consider your younger employees, okay? a big part of getting ahead when you're a younger employee is just being there. It's just being seen. It's the FaceTime with your boss that, when you're like, in other words, your boss is just walking around the office and, oh, hey, who won the football game yesterday? Oh, hey, who's doing this? Oh, hey, who's doing that? Or they may come in unexpectedly and say, oh, hey, I had a customer who backed out of the golf outing this afternoon. Hey, you want to come and you want to come and golf with us for a few hours or whatever? Bingo, that's your foot in the door. Boom. And I remember seeing some articles about like remote workers complaining that like they weren't getting the opportunities that some other employees were getting because they were there in person. Well, it's like, well, hey man, they're there in person. They're gonna get those opportunities. They're gonna get to know the boss better. They're gonna get to know the higher ups better, which is going to potentially endear them more to those bosses, and they're the ones that are gonna get the promotions, man. Like that's what happens. That's how it works. So it's just, like I said, it's just an interesting thing there. And I don't want to unfairly just totally knock and beat up remote work, because I think that in certain instances there are jobs for it, and it can be fine. And like I said, and also like hybrid work. Like I don't necessarily see anything wrong with hybrid work. But again, there's a lot to be said for just working. Like I personally, like in my daily job, I like going to the office every day. I like being in the office. I like being with my team. I like being around with conversing with a lot of people. I think I'm a people person. I'm an extrovert to a very real degree. But that, I don't know, that's just me. Like that's what I like. But I'm sure some people will find a way to disagree, or if you have comments on that, leave them in there. I mean, whatever. But anyway, okay. So I just want to wrap up, just tell everybody, hey, keep an eye out for some of the episodes I got coming up this week, especially the open banking episode. Everybody needs to check out the open banking episode. I'm working on some other things with that. I'm hoping to have some interviews for everybody soon on the whole open banking topic that I think people will find very enlightening, be really, really good information. I'm hoping, again, with like the beneficial ownership information, hopefully we get some good news on that in the next few months, or definitely this year as the year goes on. But definitely check out that open banking episode this week. It's so important, so important. It is a massive topic, and it's one of these things where so few people know about it, so few people understand it. So I'm hoping that by putting some of this information out there, at least I could get, if I could get 10 people educated on the topic, I'll be happy, because that's a force multiplier, right? Those 10 people will then go tell 100 people, and then that 100 people will go tell 1,000, and like that's what you're hoping to have happen. So check out that episode on open banking. Check out some of the other episodes out there on the podcast, and like I said, keep an eye out for, hopefully on the 20th, I'll roll out the financial history series and see if everybody likes that. But again, I thank everybody so much for coming on. And like I said, I'm trying to make this run at 1,000 subscribers. So if you like what you're seeing, please spread the good news, spread the good word about the podcast. I really appreciate it, would love it. And I thank everybody so much. So just remember to like, share, and subscribe, as that always helps the channel. Remember that we are on YouTube, Rumble, and all major podcast platforms. Please be sure to check out some of the other content on the channel. I love you all so much for doing that. And with that, I bid you all a fond farewell for this Saturday evening. I hope everybody has a great rest of the weekend. If your team is playing in the playoffs, go. I will say I am a college football fan, and I'm a Notre Dame fan. I know hopefully everybody won't beat me up too much for that, but yeah, I'm pulling for Notre Dame on January 20th to hopefully win the national championship. But I don't know, Ohio State is so good. They are a really, really good football team. So we'll see what happens there. But yeah, like I said, hope you enjoy all the sports, all the other things going on, all the family time, all that good stuff out there. And I'll see everybody again next weekend. So see everybody later.